I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. When you own property or investments that are worth more than what you paid for them, you have unrealized capital gains. And if you are to sell such positions, you will then have to realize the gains and pay taxes on them. But if you die while still holding those positions, all of the unrealized taxable gains go away upon the transfer of the positions to your heirs. I'm about to explain how. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. When you buy assets such as real estate or traditional financial investments like stocks, bonds, or mutual funds, the total price you pay is known as your basis. In other words, basis is your cost in a position. If you eventually sell a position and the total value of the sale is more than your basis, you will have what's called a capital gain. And capital gains are typically taxable, or at least they are if the position is held outside of a qualified account like an IRA or a Roth IRA, because in such accounts, there are no tax implications when buying or selling something inside the account. Instead, if taxes apply, you'll be taxed upon making a withdrawal, not upon selling something inside the account. This video assumes the investment is held outside of qualified accounts. Like if it's physical real estate, you simply own it in your own name. Or if it's stocks, bonds, or mutual funds, you hold them in normal brokerage accounts, not tax-deferred or tax-free accounts like IRAs or Roth IRAs. If you sell a position that has a capital gain, you will have to pay tax on the gain. But if you instead hold the position until you die and then pass it to your heirs, the taxable gain you'd otherwise have to pay if you sold it while you were alive magically goes away. This is due to the step-up in basis. I'll explain. Let's look at an example of how this would work for a highly appreciated security, which is a financial investment that has a large unrealized capital gain. I won't name names, but let's assume 20 years ago, in October 2000, you bought $1,000 of stock in a particular large tech company that makes computers and also makes cell phones and other consumer electronics now. That $1,000 is your basis. And now, fast forward 20 years to today, October 2020, and that company has since done phenomenally well, such that the $1,000 investment has a current market value of about $375,000. Yes, these are actual figures for our unnamed large technology company. Here's a graph of the value of your position over the last 20 years. Clearly the stock has performed very well, but now you have a really large unrealized gain in the position. Specifically, if you were to sell it, you'd have a $374,000 taxable gain. Your gain is equal to the position's current value of $375,000 minus your $1,000 basis. If you want or need to sell the position to cash it out, you can, but you may have a really big tax bill that year. Even though you've held the position for more than a year, which means it would be considered a long-term capital gain, and therefore taxed at rates that are lower than your ordinary income tax rates, it would still be a lot of taxes nonetheless. But what if you didn't actually need the money from the position? In that case, you can hold on to it the rest of your life and give it to your heirs after your death. Under current tax legislation, doing so would mean all of that unrealized capital gain would simply disappear. And that will be due to the step up in basis, as you'll see in a moment. Here's a timeline from October 2000 to October 2020. In our example, you originally paid $1,000 for the stock. That was your basis. And then as of today, the position's market value is now $375,000. If you were to sell the position, you'd have a $374,000 taxable capital gain. But what if you didn't sell it? Let's instead assume you unfortunately died today. Your heir would inherit that position from you, and the basis of the position in the hands of your heir would be increased or stepped up to the position's value on the date of your death. That's what step up in basis means. Along with the stepping up of the basis, all the unrealized taxable gain in the position from when you were alive completely goes away. Your estate won't have to pay tax on the gain, and neither will your heir. Now let's assume a year goes by and it's October 2021, and further assume the stock price has increased such that the total position is now worth $400,000. And assume your heir chooses to sell the whole thing. Because your heir's basis in the position was stepped up to $375,000, your heir will only have to pay tax on the $25,000 capital gain between the $400,000 current value and the $375,000 stepped up basis. Your heir would not have to pay any capital gain tax on the original $374,000 of gain from during your lifetime. As you can see, step up in basis can be a very powerful estate and tax planning tool. There's another comment I'd like to make about step up in basis. Regardless how long your heir holds the position after your death, Any subsequent gain will be considered a long-term capital gain. This is important to know and makes the benefits of step-up in basis even more valuable. As I mentioned before, tax rates on long-term capital gains are lower than tax rates on ordinary income. Typically, if you sell a position less than a year after buying it, any gain would be considered a short-term capital gain and will be taxed at your normal income tax rates. But if you hold it more than a year, it would instead be a long-term capital gain. With inherited assets, all gains are treated as long-term capital gains even if you sell the position only days after inheriting it. You don't need to wait a year before selling it to take advantage of the lower long-term capital gains tax rates. And before wrapping up, keep in mind everything I discussed in this video is only in reference to federal income taxes. This video does not address how individual states may tax such transactions. And finally, keep in mind that all tax legislation is subject to change. Unfortunately, step-up in basis is no exception. As of the filming of this video in October 2020, step-up in basis is one of the tax code items that's under discussion to potentially be eliminated or at least amended. With that said, it's unclear how long it will continue to be around in its current form, if at all. Well, that's it for step-up in basis. I hope you found this video helpful. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes and Retirement, where you can learn all about tax-efficient retirement planning. Thanks for watching. I'll see you soon.